What's going on, you guys? My name is Zach Hartley, and in this video, I want to talk about investing for beginners here in Canada, so let's jump right in. Okay, so the first thing you need to think about before you get started investing is, are you ready to invest? And two questions to ask are, do you have any debt with interest rates above 5%? Because if you do, you should pay those off before you get started investing. That interest rate and that debt is gonna weigh you down, and it's gonna basically eat away at the gains you make in the stock market. So pay off your debts first. Now, the second question is, do you have an emergency fund? And what I mean by an emergency fund is a cash pool of savings that you can rely on in case something goes wrong and everything basically collapses in your life. Do you have somewhere between 2 and 6 months worth of expenses saved up that you can rely on in case something terrible happens and you lose your job or the market crashes? Can you survive and can you get through it? You need to have that figured out, and you also need to pay off all of your debts before you start investing. Now, once you are ready to invest, the number one thing you can do to benefit yourself is figure out what type of investor you want to be early on. Now, here on the screen, I've listed 4 different types of investing. The first one being a dividend investor. Now, a dividend is a payment that a company makes back to its shareholders in order to basically thank them for holding the shares and buying the stock. And so those dividends are trying to give cash flow back to the shareholders in the form of dividends. And as an investor, I can buy a bunch of dividend paying companies and they will all pay me usually on a quarterly basis, and I can do whatever I want with that money. And so that is one type of investing. It's a very popular type of investing. A lot of people live and die by dividend investing, and that's one kind of primary section. The other kind of section is for the companies that don't pay a dividend. Now, when they don't pay a dividend, basically what they're doing is they're keeping that money in their bank account and they're investing it back into the company, usually to grow the company. And so they keep that money, they invest it into the projects, and they try to expand the company's revenue and the profit margins, and they try to just basically make the company worth more money, which would increase the share price. And so a growth investor is the second kind of investor here, and what they're looking for is appreciation in the shares that they own. What I mean by that is they just want the price to go up in the shares that they own, buy low and sell high. That's what they're looking for here. Now, for somebody that's looking for something a little bit more short term, you could be a swing trader, and that's somebody that will buy a stock and hold it longer than one day, but usually less than 6 months. And a day trader is somebody that will buy and sell within the same day. Now, the reason that this is so important to figure out what type of investor you are early on is because this will dictate not only what strategy you use, but it will also dictate what account is best for you and what platform you should be using. And so the sooner you can figure this out, the sooner you can get better at one of these categories. And it's kind of like growing up and going back and forth between sports. It can be done, but it's really difficult to do. And the sooner that you kind of focus on one, the better you're going to be at it. And so I highly recommend trying to figure this out before you invest your money and before you open accounts. Try and figure out, do a little bit more research. Are you a dividend investor and you want the cash flow now? Are you a growth investor and you want the share price to go up? Or are you going to be short term and be a swing trader or a day trader? The sooner you can figure that out, the better. Now, the different types of accounts here in Canada, we have 3 different main accounts that people use. The first one is called the TFSA. That stands for tax-free savings account. And when you buy a share, when you put money into your TFSA and you go buy a share of Apple at $100, if it turns into $200 and you withdraw it and you sell it and you take that money out, you don't have to pay tax on that basically profit that you just made. That's why it's called a tax-free savings account. It's actually an investment account. They call it a savings account. Shouldn't be called a savings account. It is an investment account because that's the only way you make money with it. And so you have to invest your money. You go buy a share. If it goes up in value, you do not have to pay taxes on the profit that you make there, which is really, really nice. Now, the second type of account here is called a registered retirement savings plan. And this is also referred to as the RRSP. And again, this is not a savings plan. This is an investment account. The only way you make money is when you invest your money after you put it into these accounts. And so they say savings, but they're really investment accounts. Now, the advantage of the RRSP is that it is tax deductible contributions, meaning that if I put $10,000 into my RRSP this year, I can reduce my income by $10,000 on my taxes this year, meaning that I will pay less in taxes. So if I make $100,000, I can reduce my income to $90,000 and then only pay taxes on that $90,000. For instance, that would have saved me like $3,000 or $4,000 in taxes. And so the TFSA saves you money on taxes when you pull money out, and the RRSP saves you money on taxes when you put money in. Now, the third type of account here is the margin account, and this has no tax advantage, but it is really good for day trading because your trades will settle quicker. You can borrow your money and you're never going to get penalized for day trading using a margin account. But because the TFSA and RRSP have tax advantages, the regulators and the government does not want you to day trade in a TFSA or an RRSP. So just keep that in mind. Now, the platform that you choose is also going to matter. Here we have a variety of different platforms here in Canada. The first one we're going to talk about is the mobile applications. The most popular one is called Wealthsimple. It's a decent one, but the problem with Wealthsimple is that you can only hold Canadian currency. And so if you buy a US stock, you pay 1.5% conversion fee there, and you pay another 1.5% conversion fee on the way out. And so they really gouge you there, especially if you're trading with a couple $1,000s. It can really add up. And so the platform that I'm really looking forward to is called Flamingo. They're launching in the next few months here, and they are a Canadian mobile application that allows you to carry both Canadian and US currency. So that is a major deal, and I'm very excited about that. If you're a long-term investor and you do your research somewhere else, you can then manage your portfolio on Wealthsimple or Flamingo. Really easy to do, both super user-friendly, but they don't give you a whole lot of in-depth technical analysis or research. And so that is where you may want a desktop platform. And so the two desktop platforms that are available here in Canada are Questrade and Interactive Brokers. Now, I have accounts with both here, but I use Questrade on a daily basis because I find the user interface is a lot more user-friendly. It's a lot easier to understand. It's a lot easier on the eyes, and I like the technical analysis a lot better on Questrade. I also have a link for Questrade down below that if you sign up using that link and you create an account, they will give you $50 in free commission, so you won't pay a thing to buy and sell different stocks, which is really nice. So I personally recommend Questrade. That's the one that I use for both my day trading and long-term investing, and so I highly recommend Questrade. Now, once you have your platform selected, what you need to think about is currency. So like I said, Wealthsimple will only allow you to store Canadian dollars, and they will charge you that currency rate when you buy and sell. It's a 1.5% charge. So if you're dealing with $10,000, like that's $150, you need to think about that for a second. I recommend Flamingo. It's not available yet, but you can get on the wait list. I'll put a link down below. It's really cool. I know the guys that are building it, and I'm really excited for it to launch. Now, if you are interested in using one of the desktop platforms, I highly recommend Questrade, and they have a strategy on there called Norbert's Gambit, where basically you buy a Canadian security and then you have Questrade converted into a US security, and then you sell it at the market price, and therefore you've just converted your Canadian dollars into US dollars. And so that is a really nice and easy method for dealing with currencies, especially if you want to buy US stocks. I made a video on my channel where I converted like $20,000 Canadian for a fee of like $10 or $11. So I promise you that's the best way to deal with it, especially if you're dealing with like $10,000 to $20,000 or more. Then Questrade using Norbert's Gambit is probably going to be the best way to convert your currency. Now, when it comes to the strategy of investing, the first thing I'm going to do here is focus on the long-term strategies. And so number one here, the first strategy that I would recommend if you want to build your own portfolio, if you want to do the research and find your own stocks and you want to build your own portfolio, and you're that guy and you say, I want this stock, that stock, this stock, and this stock, then this is probably where you should start, or at least a framework like this. So number one, choose 5 different industries that you think are on the uptrend or that are going to see growth or that are going to be big in 5 to 10 years. Choose 5 industries that are going in the right direction right now and will probably be going in the right direction in the next few years. And so once you have those industries, then go in and choose 2 companies from each of those industries. Maybe choose 1 company in each country, maybe choose a large company and a growth company, maybe choose the 2 biggest companies, maybe choose your favorite company or the best company and one of the small companies that's really up and coming. However you want to decide that, but go in and choose 2 companies from each industry. And at the end of this, you will then have 10 different companies in your portfolio at a roughly 10% weighting on each stock, and you'll be in 5 different industries, so you should have good diversification. Now, depending on whether you're a growth investor or a dividend investor is probably going to influence what type of industries you're going to be buying into. So for instance, technology companies and software companies and platform companies probably aren't paying a dividend, but in the current times, they're growing extremely quick. So those would work well in a growth portfolio. However, if you want to build a dividend portfolio, you might be looking at oil and gas companies, utility companies, mining companies. You're going to be looking for industries that are kind of consistent and steady and where the companies can afford to pay that dividend back already. So depending on what type of investor you are, that's what's going to dictate what type of industries you invest in, and then the types of companies in each industry. And so if you're a dividend investor, obviously you want to choose the 2 healthiest companies with the highest dividend ratios that are at no risk of defaulting. That's kind of what you would be looking for. Now, strategy 2 here is going to be a little bit simpler. This is probably what I would recommend for most beginners because this is going to be the safest and the most steady way to generate a return on the money that you invest. And so this strategy is buying an ETF, which stands for exchange traded fund, or an index fund that represents the market. And so what this is one security. So you're basically buying one ticker symbol, one kind of stock, but within that stock, it represents like 200 different stocks or 500 different stocks that either represent the broad market or a specific industry. And so what I would recommend is if you're starting out, I would go buy the S&P 500. That represents basically the broad market index for the US. Now, you can do this by either buying the ticker symbol SPY, that's going to be the US version of the S&P 500, or you can buy the ticker symbol ZSP, that's going to be the BMO S&P 500 Index ETF, and that's going to be the Canadian version. And over the last 10 years, these have returned on average 14.7%. And so this is going to be the safest, most steady way to invest your money. You're going to pay very low commissions or no commissions depending on what platform you choose, and it's going to instantly give you perfect diversification, perfect portfolio balancing, and you're going to be well diversified so that you're set up and ready to go with just one transaction, and you could put 100% of your portfolio into this and it would give you that diversification and that kind of consistent long-term return. Now, the other option here is that you can also add an industry ETF. So for instance, if you want to focus on e-commerce or you want to focus on artificial intelligence, you can find an ETF that will focus on each of those industries and you can add them to your portfolio. Maybe you go half and half with the S&P 500. Maybe you add 3 or 4 in there, whatever works best for you, but you can build an entire portfolio based on ETFs. And in doing so, you could hold, let's just call it 2 or 3 ETFs. And within those ETFs, you could have exposure to over 500 or 600 companies very, very easily and with very low commissions. And so this is probably the easiest, long-term, safest way to get some returns by investing your own money and managing your own portfolio in a very safe way is by going through the ETFs and buying a broad market ETF. Now, the third strategy here is going to be swing trading and day trading. This is going to be the short-term trading, and this is based on technical analysis, which refers to looking at the stock chart and looking at the price chart. Now, if you're interested in this, I have an entire course on it, and the link is down in the description down below. But we'll talk about that in just 1 minute. What I want to talk about first is taxes, because deciding on what type of investor you're going to be, like I said, is very beneficial because it will help you understand what type of account to get into, and those accounts have different taxes. So for instance, withholding tax is a tax that happens to your dividends. Anytime you buy a US company that issues you a dividend as a Canadian citizen, the US government will take 15% of that dividend as a withholding tax. Just because. I don't know why they do it, but it's called a withholding tax, and it's 15% of that dividend. However, if you hold that company in an RRSP account, there is no withholding tax. So just by understanding what type of investor you want to be and choosing the right account, you can instantly keep 15% more of your dividends. And so that one is super important. However, if you're looking for growth, if you're a growth investor and you're looking to buy Apple at 100 and sell at 200, then that would be considered a capital gain when the value of the asset goes up and you make money on it going up, that's considered a capital gain and you have to pay tax on that. And when you're looking for that type of growth, it's going to be best to use a tax-free savings account because there's no capital gains tax in that account. And so deciding what type of investor you want to be and investing in the right account on the right platform can make all the difference. And I hope I helped you with that video today. If you get anything out of this, make sure it's use a TFSA or an RSP until you max it out. Now, if you're interested in learning a little bit more about how to understand the stocks, do some technical analysis, read the financials, and learn more about how to choose the right stocks, then definitely consider signing up for my Stock Market Fundamentals course. It is completely free and it's hosted on Skillshare, where you will get access to the entire platform, including my 9-hour course that will walk you through step by step everything you need to know to get started investing your money in the market profitably. Now, there's over 7,000 students that have already gone through the course, and there's 300 reviews for you to take a read through, and I promise you it'll be the best free resource that you can find online. The link is in the description to this video down below. Now, if you got any value out of this video, remember to click that like and subscribe button, and we'll see you in the next one. Good luck trading, good luck investing, and we'll talk to you soon.